everyone, welcome back to another episode of Trading Kaki's weekly series where we give you a market roundup and our stock picks for next week. This week, the key macro data released was the Fed Chair and other president speeches as well as the consumer sentiment data. Fed Chair Jerome Powell mentioned that the disinflationary process has begun. However, rates will have to remain at a restrictive level for a period of time including next year in order to meet their 2% inflation target. Fed President and CEO John Williams also mentioned that further increases of a quarter percentage point or 25 basis points seem like the right size and that peak rate forecasts are still very reasonable. With that, we maintain our stance as of last week where we mentioned that any cuts in interest rates will be less likely this year and if anything we'll probably see a halt in interest rate hikes. The University of Michigan released their monthly consumer sentiment survey and as of February not only did it beat market forecasts but it's also at a 13-month high. There's still a long way to go as even though it's 6% above where it was a year ago, it's still 14% below where it was 2 years ago before this current inflationary episode. Inflation expectations, which are also released in the same survey, was increased to 4.2%, previously it was 3.9%. However, the 5-year or longer-term outlook was maintained at 2.9%. Next week is a major week for the market. We have inflation data or CPI coming out on Tuesday, Valentine's Day, and that would help us to assess where inflation is going and thus where interest rates will be heading. On the following days, we have retail sales and building permits, which would both help us to assess where economic activity is headed in these different parts of the economy. Let's take a look at how the markets have performed. For the SPX, there was positive reaction to the Fed speech where it closed at a weekly high. From there, it started to pull back, however, it stayed within the upward channel. The Dow Jones remained flat, and this line that you see over here is a strong resistance level of 34.5 that we have also identified last week. The Nasdaq topped out and broke out of its upward channel on the downside, however, it closed slightly above its 200-day EMA, which is the red horizontal line that you see over there. Similar to the Nasdaq, small and mid-cap stocks corrected sharply and it broke downwards of its upward channel, however it closed slightly above its 20-day EMA, which is the green horizontal line you see. Volatility spiked this week as markets remain watchful of CPI data that's going to come out next week. It broke out of its downward channel and last Friday it even shot above its 50-day EMA, however it did close below it. The dollar index consolidated above 102.5 after rebounding from levels below 101. And we have identified the next resistance and support levels. Chinese stocks continued to be weighed down by the ongoing China-US tensions and the Golden Dragon China Index broke out of its upward channel on the downside. The spread between the 2-year and 30-year government bond remains wide and in fact this week it has widened even further. This means that recession concerns have increased. There's been a sell-off in cryptocurrencies, namely Bitcoin and Ethereum, as we see risk-off sentiment resuming, especially with CPI data coming out and markets are remaining watchful. The energy sector was the only sector to close positive this week, as there was news on Russia planning to cut oil production next month, which sent oil prices rising over 2% on Friday. The worst performing sectors this week were real estate, consumer discretionary, and communication services. This is actually part of a broader market sell down ahead of the CPI data coming out next week. This is actually a typical market move as well, as if there's any upside surprise to inflation data that we will see next week, we will see another big leg down. We'll cover the earnings of 3 key companies, Disney, Uber, and PepsiCo. Disney's revenue and EPS both beat estimates, and this was the first set of results since the return of its longtime CEO Bob Iger. In fact, 2 days ago, Bob Iger was on an interview with CNBC where he called streaming the future. This is in line with his FY23 guidance where he expects to reduce much of his non-content related expenses. On the whole, we see Bob Iger's restructuring plan as gaining some traction, and recent measures such as the laying off of close to 4% of its global workforce as well as the reduction in operating costs will continue to favour their financials in the short term. The key growth engine going forward would still be its Disney Plus platform, and we also start to see some recovery in its Disneyland segment as international tourism recovers. And we have Uber, which is one of our stock picks last week. Both revenue and EPS beat estimates, and the guidance for next quarter will be that gross bookings will grow up to 24% year-on-year. Our take is that the 2 key catalysts that we identified last week, which is the expansion into new markets as well as the growth of its Uber Eats platform, remain. There's another catalyst as well, which is the launch of Uber's car share platform in Australia, which is poised to disrupt its 100 billion car rental market. PepsiCo, which of course has more product lines outside of Pepsi, as you can see in the picture here, also beat estimates on both its revenue and EPS. The company will continue pushing more into the zero sugar sodas and the higher price or more premium drink segment. Even though the soft drinks market is competitive, Pepsi has found a competitive advantage, and this will be a defensive play in the event of a recession. These are the key upcoming earnings next week. We have identified here in the red boxes the key ones to look for, which includes Palantir, Coca-Cola, Cisco, Shopify, DraftKings. We have two stock picks for you this week, which is Enphase Energy and CF Industries. Enphase Energy actually reported earnings a few days back. Even though their earnings were better than expected, there was a sell-off, and this was mainly due to the guidance that their business will be slightly down in the next quarter compared to the quarter that was reported. So we see this correction as being kind of a knee-jerk reaction, and we expect a recovery following this correction. The other catalyst would be its healthy growth drivers with its plans to increase production for its microinverters, and we also see some traction for its EV charging system, especially with the increase in EV and solar adoption in Europe and US. These are recommended entry and target prices with the recommended stop loss price as well, so you see a risk reward ratio of about 2 to 1 with a potential profit of 25% and a stop loss price of 10%. Next stock pick will be CF Industries. The first catalyst will be the lower prices of its raw materials. So for CF Industries, the main raw material and fuel source for its fertilizer production is natural gas. So naturally, natural gas prices having already plunged nearly 70% from the recent highs last November, this will continue to improve its margins. Of course, its average selling price will also be adjusted lower accordingly. However, the company is expected to maintain high profit margins, and this will be way above even its pre-COVID level. The next catalyst will be the seasonality effect. So in February, which is the month that we're in right now, is usually the best month seasonally, where farmers replenish fertilizer inventory. So as they replenish their inventory in this month, this will uphold and bolster sales volume and prices in the first quarter of this year. These are recommended entry and target prices for CF Industries with an entry price of $90 and target price of $105. You can see that the last close as of Friday is very close to our entry price. As usual, we will apply a 2 to 1 risk reward ratio with a potential profit of about 17% and a stop loss of about 9%. Let's review our stock picks last week. So we had two stock picks, Uber and Airbnb. Uber not only hit our target price but also exceeded our target price of $37.50. So if you have entered at a weekly low of 32.9, which is not far from our entry anyway, which was 32.5, you will have profited close to 15%. And bear in mind that this was just 1 week of our stock recommendation. So if you have entered this trade, congratulations and hope you enjoy those gains. For Airbnb, we saw it trending close to the 118 to 120 level for the most part of the week. However, on Friday, it closed below our entry price of 110. So if anyone is thinking of still going to this trade, this is a good point of entry as we still see the two key growth catalysts that we identified last week being intact. Do bear in mind that their earnings will be out next week as well. And any trades that are done are at your own discretion, at your own risk and capital. That's all we have for this week. We hope you enjoyed the content. Please like, subscribe and set alerts on our channel so you'll be notified on our video uploads every Sunday. We are also very active on our Instagram page, namely our IG stories, where we'll post almost daily updates on the market news, especially with all the macro events and news coming up, as well as market movements on our stock picks.